Plug Power has had a rough 2023. The stock is down 61% so far this year. And this is a company that came off of massive highs during the pandemic. A lot of hope about what the company was going to look like in the future, how it was going to grow into things like electrolyzers. And some of those things have started to materialize. This is a company that continues to grow, it continues to innovate and install new products, but there are a number of challenges that investors specifically are really worried about that heading into 2024 should give investors even more pause. So that's what I'm going to get into today is some of the progress the company is making and then how we should think about this as an investment because it's a $2.8 billion company that may not be on as solid a financial footing as we would like. My name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. Check out fool.com/ASYM for their top 10 stocks to buy right now. And let's start by just looking at the chart quickly. This is the chart from Google. Like I said, 1 year down 61.5%. And over the last 5 years, this has just been an insanely volatile stock. You can see that 5 years ago it was $1.48 per share. So that's why it's up 251%, but was trading in the mid 60s in early 2021. It's just been a massive decline since then. So what's the reason for that? Well, the biggest reason is Plug Power's income statement. So I'm going to start with the income statement and show the cash flows and then the balance sheet, because this is where things start to get a little bit hairy for Plug Power heading into 2024. So you can see that revenue was up slightly for the year, $198.7 million in the most recent quarter. If we go to the 9 months, if we go to the last 9 months, $669.2 million in revenue. So really solid revenue, really solid growth. The challenge for Plug Power has always been making money. And there's two line items here that I want to highlight because if we look at, and I'll focus on this 9-month segment. If you look at the $669 million in revenue, the total cost of that revenue is $951.7 million. That means that they're losing nearly 50 cents on every dollar in revenue that they're generating. That's just on a gross basis. We haven't even covered selling, general, and administrative, paying overhead costs. But the two line items that are really concerning is sales of equipment, related infrastructure, and other. So $504 million in cost against $543 million in revenue. So barely squeaking out a 10% gross margin on your biggest segment. Now, remember, Plug Power is not a startup. This is not a new company. This company is decades old at this point. And they're still not at the point where they're making sales of equipment profitably. You could look at this as a razor blade model saying, hey, maybe we don't need to make that much money on equipment. We're going to make money on fuel or power purchase agreements. Okay, well, let's look at those. Start with fuel, $47.4 million in revenue. What was the cost of that fuel? $178 million. Losing nearly $3 for each dollar in revenue from fuel. Power purchase agreements, similar thing. $444.1 million in revenue, cost $158 million. Those are just staggering numbers, and there's no way to get around the fact that Plug Power is just losing money on everything that it sells. There can be minor excuses for that, like the way that you account for projects and power purchase agreements that would make a lot of sense. But these numbers are so far out of whack from being profitable that I think we can clearly say that Plug Power is losing money at an unsustainable rate. If we add in things like selling, general, and administrative costs, research and development, we got to develop those new products. We're talking about another $400 million in costs in just the first 9 months of the year. That's how you get to this massive $726 million loss. Okay. I'm going to go to the cash flow statement, but keep that number in mind when we go to the balance sheet. Here's the cash flow statement because this can maybe tell a little bit different story. And with a lot of companies, especially today, if you have non-cash costs or you're writing things off, maybe this net loss doesn't tell the whole story. But what do we actually see here? Well, you're adding back $129 million in stock-based compensation, but you're also increasing your inventory by $411 million. The cash used from operations is $864 million. That is on top of another $484 million in property, plant, and equipment purchases. So the cash burn, and remember, this is again just for 9 months in 2023. So the cash burn is completely unsustainable Going up to the balance sheet, now we can see why the company had to give investors a going concern warning. That's when you tell investors, hey, we don't know if we're going to be able to stay open as a business unless we're able to raise capital in the future or change something about our operations. I'll get to that warning and what they said about that in just a second. But there's only $111 million in cash on the balance sheet. There is restricted cash. And then there's also $389 million in available for sale securities. So those are securities that they could sell to raise funds, but isn't just cash sitting on the balance sheet. So add those three things together and you get a little over $700 million in cash. But again, that is less than a year's worth of cash burn currently. So this is the line that stuck out to me in the most recent earnings release. The company's existing cash and liquidity position means they'll need to access additional capital in the market to fund activities. And they laid out a few things they could potentially do here. Corporate debt, U.S. Department of Energy loan program, and that would be to fund the green hydrogen network. And then project financing and plant equity partners. And that's, again, typically going to be for the hydrogen power plant network. And this is ultimately, I think, the fundamental problem for Plug Power is that they're not only trying to develop the technology, they're actually also trying to finance a lot of these growth projects that they're building. This hydrogen network is something that they're actually trying to build out themselves. Green hydrogen network and plant updates, they're doing this work themselves. And that also means financing these projects. That's not the case for every project, but this is definitely going to be a cash sink if Plug Power wants to build out this hydrogen network themselves. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So where does this leave us with Plug Power heading into 2024? Well, we have the same challenges that we've really had for the last decade. There's a lot of potential, a lot of growth, but Plug Power has not shown the ability to sell the products that it makes profitably. It is really good at making high-profile press releases, announcing big partnerships with massive companies, but then we find out later that those companies actually had the leverage and they were the ones controlling the terms. Remember that Walmart and Amazon got warrants to sign deals to convert their forklift operations to hydrogen, which Plug Power has done most of that work. That's now starting to move into the electrolyzer market, but those projects were not profitable. So what evidence do we have that the electrolyzers are going to be profitable? On top of that, you have the financial strain on the business. Plug Power's balance sheet just simply isn't as strong as it once was, and this cash burn is only getting worse. At the same time, the stock market is actually telling us that they don't want to fund Plug Power's growth ambitions for much longer. As the stock falls, you start to lose financing options. So it makes it harder to raise equity. It makes it harder to raise debt because debt holders are going to be the ones that are fighting for the scraps of the company if Plug Power doesn't survive. So debt holders would rather see the company get to profitability and maybe even raise equity than to sell more debt, which just increases the risk from a financial perspective. So this is really a catch-22. And at the end of the day, Plug Power has to get to profitability. And the number of options are really starting to close to either do that or raise more money. There's already about $200 million in debt on the balance sheet. So I think this is really going to be a challenging year for Plug Power. I don't see the growth in the hydrogen market or even the electrolyzer market being what a lot of people anticipated it was going to be a couple of years ago. This is going to be a steady growth market over the next 2 or 3 decades, but it's not going to be a rocket ship like a lot of people thought it was. So Plug Power's stock, I'm absolutely staying out of. I've been saying that for a very long time. And outside of these bubble periods, that has been the right move, is just to stay out of Plug Power. It's far too volatile, and the core operations of the business are far too weak. But what do you think about Plug Power? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.